Welcome back to The Explainer. So, you've probably been told since you got your very first piggy bank that saving cash is absolutely the smartest, most responsible move you can make. It's conventional wisdom, right? But today, we're looking at some data from institutions like Kernel Wealth and Bajaj Finance that's going to completely flip that idea on its head. It turns out that traditional advice we've all been following, it might actually be broken. Let's dive into it. I know, it sounds totally counterintuitive. Why on earth would saving money be a losing game? I mean, if you don't spend it and nobody steals it, it's safe, isn't it? Well, actually, no. The hard truth is that the cash just sitting in your traditional savings account right now is quietly evaporating every single day. The financial system is structurally designed in a way that actually drains the wealth of pure savers. Let's break down exactly why that happens. I absolutely love this quote. Money that sits still loses to money that grows. Think about saving fiat currency, your standard dollars, euros, or rupees, like running in place on a treadmill. You're sweating, you're putting in all the hard work, and you feel highly responsible for doing it. But meanwhile, the rest of the economy is just gliding right past you on an airport moving walkway. If your money is just sitting still, you aren't just standing in place. Relative to the actual cost of living, you are actively sliding backward. Part 1. The Silent Thief. Let's see how inflation and taxes tag team your wallet. To really understand this invisible drain, we've got to talk about the real rate of return. When a bank tells you they're paying you, say, 3 or 4% interest, that's just the nominal rate. It's basically a deceptive illusion. The real rate of return is what you actually get to keep after the silent thieves of taxes and inflation take their cut. They work together to silently erode your purchasing power, and they do it without you ever noticing a single missing cent from your bank balance. Okay, this statistic from Kernel Wealth literally blew my mind. Imagine locking your money into a 12-month term deposit that's offering a 3.7% interest rate. Sounds pretty okay, right? But wait, subtract a standard 30% tax rate on those earnings, and your return drops to 2.59%. Now, factor in an inflation rate of 2.7%. Your real rate of return is actually negative 0.11%. Your money is literally shrinking while it's locked inside a bank vault. You can buy less with it today than you could a year ago. When you look at different inflation environments, and this is based on some really interesting insights from Bajaj Finance, the math gets even scarier. Let's say you've got an initial savings of 1 lakh rupees, earning 5% interest. At 2% inflation, you survive. The impact is minimal. But watch what happens when inflation hits 8%. Even with your 5% interest, the real purchasing power of your money drops to roughly 96,000 rupees. At 10% inflation, it plummets to under 91,000 rupees. Higher inflation mathematically destroys your purchasing power, even when your bank is supposedly paying you to keep it there. Part 2, the massive cost of rating. So aside from inflation, there's a second, much larger penalty to hoarding cash, and that is opportunity cost. And this cost is massive. Based on historical data from Kernel Wealth, if you left $20,000 sitting in the bank earning standard interest over 5 years, you'd have made about $3,300. But if you had invested that exact same $20,000 into an index fund tracking the S&P 500 over that same 5-year period to August 2025, you would have earned over $24,500. The cost of perceived safety wasn't just a few bucks, it was over $20,000 in lost wealth. Let's stretch that timeline out even further, because time is where the magic really happens. Take the saver. They put away $100 a month for 30 years at a standard 0.5% savings rate. They end up with about $39,000. Now take the investor. They put that exact same $100 a month into the market at an historical average of 8%. They end up with $150,000. I really want you to let that sink in. This is the exact same effort, the exact same discipline, and the exact same amount of money out of your pocket every single month. The only difference is where the money was parked. It completely highlights how the financial system is structurally designed to reward asset owners while completely leaving pure cash savers in the dust. So, the absolute crucial point here is urgency. As this quote powerfully points out, wait 10 years to start contributing, and you'd have to put in more than twice as much a month to reach the same goal. Waiting around for the perfect time or trying to time a market dip just forces you to work exponentially harder later on. Time is literally the greatest asset you have, but only if your money is actually out there working for you. Part 3, the shift from saver to asset owner. Let's talk about how to get off this treadmill.
I know investing can sound incredibly intimidating, right? Like you need to be some Wall Street genius glued to financial news 24/7. But the sources highlight a beautifully simple tool for beginners, the index fund. It's basically just a basket that holds tiny pieces of hundreds, sometimes even thousands of companies all at once. By owning a piece of the overall market, you spread your risk way out and just track the general growth of the economy. You're essentially betting on human progress, which historically trends upward over the long haul.
When you really compare the two side by side, the paradigm shift becomes so obvious. Fiat currency is fundamentally structurally designed to lose value. It suffers from negative real returns and gets constantly eaten alive by inflation. But compounding assets like stocks, real estate, or index funds, they are completely different. They outpace inflation, they benefit from compound growth, and they actually build real generational wealth. The financial system heavily rewards people who own assets, while it literally inflates the wealth right away from cash savers. Part 4. The action plan. How do we actually start doing this today?
Here are 3 simple rules you can start applying right now. Step 1. Build a small safety net. You definitely still need a regular savings account for emergencies, just a few months of expenses so you never have to sell your investments at a bad time. Step 2. Open an investment account. Just use a beginner-friendly platform that's regulated in your country. Step 3. Start small and consistent. Seriously, you do not need a massive lump sum to start. Investing a small amount, even just $50 or $100 automatically every single month, is incredibly powerful because consistency, it beats time in the market every single time.
Let's do a quick recap on why this strategy is just so incredibly effective. When you make this shift, every single dollar you invest is out there working for you, earning you more money while you sleep. It completely neutralizes the silent thief of inflation we talked about earlier. Through automated indexing, it requires almost zero ongoing effort on your part. It creates a robust safety buffer for your future self. And most importantly, it turns time into your greatest asset rather than your worst enemy. I want to leave you with this final, pretty stark choice to think about today. Every single day your money sits uninvested, a decision is basically being made for you. So ask yourself, are you going to let inflation silently drain your wealth? Or are you going to take control today and let compounding build it? The math is crystal clear, but the choice is entirely up to you. Thanks so much for joining me on this explainer, and I'll catch you next time.